Hello friends, today's topic 5 mistakes investors could do at bull market peak. I am Dr. Bharath Chandra. Purpose of the video is financial education of society. All investors must be very happy that markets have rallied and are at all-time high. At such a time, it's very easy to be overconfident and make some common mistakes. Following are some of the points you must keep in mind when markets are at all-time high. Many investors may know about this but still find it difficult to follow these and hence end up not fully benefiting from the power of compounding. First thing to note is don't get tempted to sell your long-term holding. Many investors think of selling all their stocks held for long-term and plan to buy back when markets fall in the future. This approach is wrong in many ways. A. How do you know this is the highest level? B. How will you know when to buy back? C. Some stocks may hardly fall even in a market correction. So, if you are a truly long-term investor, you will not sell unless you need the money or you feel that a stock is not doing fundamentally. Second thing to note is stick to quality and fundamentally strong stocks. In bull markets, all kinds of inferior and fundamentally weak companies also appreciate a lot. You would have heard that some stock A has gone up by 50% in last 1 month, etc. But many of these stocks will not be fundamentally strong. Retail investors get trapped in them. Never compromise on the quality of the stocks. Always do fundamental analysis and don't invest in stocks just because it has recently appreciated by a high percentage. Such an advice looks silly when markets keep going up. When there is a big fall, investors learn important lessons. 3. Maintain proper asset allocation. Don't overinvest in stock market just because it's bull market or it's a rally. Divide your money in various instruments. For example, assets, bank balance and PPF 10% of the total, gold 5%, real estate 50%, mutual funds 15%, stocks 20%. Now, fourth thing to note is stagger and spread your lump sum investment. In case you have a lump sum of 1 or 2 lakhs or more, etc., it may be wise to spread it over some months. In case there is a correction in the coming months, you will be able to take some advantage of that. There is no need to invest the entire lump sum in one shot. 5. Don't stop SCPs, SIPs. Irrespective of the market highs or lows, if you are a long-term investor with a vision of minimum 10 years, you must continue SCP, SIP. Don't change your approach just because of the market movement. By investing in both ups and downs in the market, you will be able to create a good corpus for the future. Always keep these points in mind when investing for long term. This will ensure that you are on the right path to create huge wealth in stock markets. End of the video, here is the question. For a mutual fund to be called an equity mutual fund scheme, what is the minimum percentage of funds should be invested in equity market, that is stock market? A. 55%, B. 60%, C. 65%, D. 70%. In case you are not the member of this channel, this is the time to subscribe, press the bell icon, send the video to all your friends. The video is good, press the like button. Thank you for watching. Bye bye. All the best.